Hey everybody, how you doing? It's Uncle Bruce here, Stock Markets with Bruce here on YouTube. How you doing today? Today's date is Sunday, my day off, June the 4th, 2023. Good to see you all. Those of you who watch me live Monday to Friday at 8:30 Eastern Time, you know what we love to do on our show every day, 2 hours. We love talking about the pre-markets, and then we talk about trading, what's going on in the markets. We do a lot of discussion here about how to write stock options and make money from the options market. Over the weekend, yesterday, I caught an article about IBM, the company IBM, and artificial intelligence. Now, many of you out there who follow the market a lot, you have been inundated with this AI investment phenomena that's really catching on. And you're trying to ask yourself, well, how do I take advantage of this? If you're a gambler, you just go out there and buy up some of these AI stocks and risk it all and hope for the best. But if you're more like myself, not quite as risk averse, how can you make money from AI, the whole AI phenomena, and yet be careful about it and not overexpose yourself to pitfalls of rising and falling markets that just go up and down like crazy? IBM is a way to go into this. IBM is going to be involved in AI for millions of clients globally. AI systems are everywhere. AI software is coming from every direction. And the IBM company will be assisting corporations, governments, and other organizations with the new technology that's coming out that everyone is heading for. You can be the inventor of AI. You can produce chips to handle the AI phenomenon, but you're also going to need a delivery network to the end customer who can then utilize it. And this is where IBM comes in handy. Now, let me give you a couple of charts on IBM, and pardon me for this low tech presentation. Believe me, I have been grappling all morning with how to show this to you. Here's an IBM chart. Don't mind my bald head here. Here's an IBM chart here for the last month. And you can see here, just over here, if you watch my finger right there, there's May the 8th, and then over here is, June 3rd, or whatever it is. And you can see the stock in the 120s into the 130 range, close to 132 Friday night, the other night. Here is a 3-month chart of the stock, and you can sure see the lovely little run that the stock has had way over here at the top here. You can see it. I'm trying to desperately show you. There's my finger. Look way over there. You see that little run over there? That's the 132 level. Here's a 6-month chart. You can see where the stock has come from since the end of the year into December. Here's a 1-year chart to give you a little more clarity. Right in the middle there is the high of the year, the 151 range. And prior to that, it was quite a bit lower, took a run, and now it's backed off and it's coming back on again. Here is a 3-year chart to give you even more perspective on IBM's history. And now this is a chart starting in June 85. I'm leaning into this chart to see it. You can look how the company bought back their stock from June 85 to June 95. Then in the 2000s, it popped up over the dollar range. They bought a bunch of their stock back. You can then see in the middle of the chart, just before the big run up, just between January 05 and January 10, you can see right about there a dip. And that was the financial crisis of 2008, 2009. And then the stock hit its all-time highs of 200 a share in 13, 14 range. And that was the height of the company buying back their stock. They were buying up 5% of their stock every year for years and years and years and years. And the idea was IBM wasn't investing in its business so much. It was investing in artificial earnings or engineered earnings, which many public companies have done and are still doing to this day, where they buy up their stock on the open market. They make a little more money than last year overall, but because you have fewer shares to divide it into, it looks like the earnings per share are just growing wonderfully. And it's an artificial way to inflate the number for the shareholders. And it can make the stock go up in value, like in this case, $200 a share. Management loves it because management gets stock options. That's how these guys get paid most of their money. And so they generate profits from having options in the $100 range, 125 range, 150 range. Stock hits the 200 level, and they get millions of shares in compensation over years and years and years. And what do? They're selling their stock into the open market while they hit 200 a share, and they're cashing in millions personally. Yet collectively, all the managers of IBM, all of the directors own less than 1% of the company combined. And shareholders, for the most part, are happy because, hey, my stock's 200 a share. It's great. It works until it doesn't work. And you can see here that the shares backed off. As you can take a look there, between 2010 2015, they hit the high. And ever since then, the stock has slumped and slumped and slumped. And so the question now is, what does the future hold? And, this is the last month. It looks pretty good if you look at that chart. And of course, like I said before, here's the 6-month chart from December and the 1-year chart now from last year to this year. So IBM is the kind of company that you can put money into the stock and just take the dividend. Right now, it's a 5% yield on your money. Safe. It's a Dow 30 component. It's the kind of stock you can own. Sleep at night. They'll be there tomorrow. Millions of clients around the world. They're not going anywhere as far as out of business. But this AI phenomenon, this is catching a lot of people's attention. And those of you who are working right now for a living and you would really like to retire sooner rather than later, and when you do retire or you're forced to retire, you want to have something to live off of that you've built up over time. You want to take funds you have now that you're holding on to and grow them perhaps a lot faster than what professionals have been doing for you. There's a lot of money managers out there who are taking 2% fees off the top of your values every year and giving you the remainder. And some of you are looking at losses in the last year or two because of the higher interest rates. Others are looking at subpar performance. And you've also noticed in the last 7, 8, 10 years, stock markets are hitting record highs, and your portfolio was not hitting record highs. And you're now in your 40s, your 50s. You're looking forward to the next 5, 10 years, and you're going, there isn't enough. There is not enough in my employee savings account, in my retirement account, for me to really realistically be able to retire on it for more than 5 or 10 years after I quit work. And that is not a good thing, because governments right now are looking for ways to cut back on Social Security payouts, making it harder to get them, more difficult to achieve them. All right. Forget all that. You need to bring in income. If you want to retire or you want to quit your day job now, you got to do some calculating. And that is, how much money do I need a month to live on? And if I make a certain amount of money per month, can I walk away from my employer's paycheck? That's what simple calculation. No real magic to it. So I came up with an idea of, well, let's suppose that, give or take, a lot of you can live on $1,000 a week, $4,000 a month coming into you. You could theoretically live on that without having to work full time. Or, because remember, you don't have to commute to the office anymore. You might not need daycare anymore. You take expenses off the top if you don't have to go to work. Can you live on $4,000 a month or so? Remember, if you bring in option premium, that's capital gains, and your tax rate is a lot lower, 15 to 20% versus your payroll taxes and everything else. But that's another topic for another day. But if you could live on $1,000 a week, how many shares of IBM do you need to have, or how many contracts do you need to be able to create or write on IBM to live off of just that? And so I came up with an idea over yesterday and today, and it's been gnawing at me. And I thought I'll make a video about it right now and tell you what I think. Here's an idea for you. Okay, you could buy the stock right Monday morning. You could buy the stock right there at 132.21. There's your final trade right there. And if you buy 100 shares of IBM at $132, you can write one call contract. And the problem is, of course, that's $13,200 to be able to write one call option. You're going to need a lot of capital to buy enough stock to write enough contracts to live off the contracts. All right. I found a contract that you can write where you'll probably clear about 50 cents a week on the contract, which is $50 a contract per week. And if you can write 20 of them, then that's $1,000 a week of profit coming to you. This is where my head is at right now. And the contract that I am thinking of having you write is a contract that expires in in August of this year. But you're not going to carry the contract until it expires. I'm not offering you an idea here where you write a call option and wait for it to die worthless at the end of its run before you've cashed out. Not at all. I'm looking at a contract where you write it now and you buy it back about 5 weeks from now, and you end up clearing about $250 on the contract, give or take. And that's $50 a week times 20 contracts, $1,000 a week. In a 5-week time frame, you clear $5,000. And you then, buy back this contract, write a new contract for probably November or December, November, October, December, and do the same thing over and over and over again. But the problem is $13,000 to write a contract to make $50 a week. It's a pretty expensive proposition. So I came up with a solution to that problem. And the solution is to buy a call option on IBM, what we call a deep in the money call option on IBM, and write an option against the option. This is known as, I believe it's known as a vertical spread, but we like to call it a poor man covered call strategy. So instead of coming up with $13,000 to write one contract, you come up with about $3,500 to write a contract. This is a lot more affordable. In other words, you can almost write 4 contracts with the amount of money it would require you to buy 100 shares of IBM. That's a 4-time leverage. Let me show you what I'm talking about. Here is an option chain that I pulled up this morning. It's on Market Watch. Any of you can go and get these. This is an option chain. If you look at the far over here on this side, right over here, you'll see at the very top there strike prices. Okay, you see that over there? So you've got $60 strike prices up at the top there, and then coming down, you have strike prices going all the way down to $130. I want you to zoom in on the $100 contract, and I'll do that for you right here. On the far right, you'll see 90, 95, 100. The $100 strike price for January 2025 is the contract that you would be buying. Notice the numbers here from the far left. $36 last trade, $350 gain on the day, $33.55 is the bid, $37.35 is the ask at the end of Friday night. There was one contract traded on Friday, 185 exist. That's a $100 contract. I'm going to zoom in now on just that contract. There it is. Okay, you can see me and see it at the same time. If you were to buy this contract for about $35, and I'm going in the middle between that bid ask there, that $33.55 and that $37.55, about $35. It's $35 a share to buy this contract. The stock closed at 132 odd on the market. This contract is worth $32 and change in actual book value because it's in the money. This is a $100 contract against $132 something stock. So this contract has over a $32 book value to it. If you buy it for $35, again, that's just an approximation, you're paying a little more, less than 10% more than the cost of the contract, the value of the contract. And this is the perfect contract to use to write contracts against it. You're basically saying to the marketplace, all right, I'll buy this call for this $100 call for $35. And I'm now going to write call options against it one at a time, 1-to-1. And let's see what happens with the market. Okay, let me go forward to the contract I want you to write. This is it right here. Notice on the top over here, there's the price of the stock Friday night, 132.42. This is a 135 exercise price contract that expires August the 18th of this year, 75 calendar days from now, approximately, or about 50 trading days from now. Remember, the markets are only open Monday to Friday. They're not open Saturdays and Sundays. They close on holiday Mondays. You take the next 2.5 months from where we are now, June the 4th, roughly, until August the 18th. That's about 2.5 months. Take away about 20 odd, 22, 23 holiday days or weekend and holiday Monday days. And we have about a 50-day trading time frame here on this contract. On the far right, on this side right here, last trade 385. Here is the bid and ask, 380 to 395 at the close of business Friday night. 833 contracts traded on Friday and 2571 exist as of Friday evening. There we go, right there. Okay, these are 135 strikes. This is a contract you'll sell. You'll write this call. You'll bring in cash. All right. Now, under perfect round number scenarios, my idea is you'll spend $3,500 to buy a deep in the money call. You'll receive about $400 to sell this call against it. And the game plan is to buy that contract back in 5 weeks from now for $150. And why would it cost $150 to buy it back when it's roughly $400 in value today? Because in 5 weeks from now, the contract has that many fewer weeks left to live before it expires. It has an expiry date of August the 18th. 5 weeks from now, we're talking about July 10th, 12th, 15th, something like that. The contract will have about a month to go before it expires. If the stock stays under 135, this contract is out of the money as it is now. The contract right now is actually worthless. It has no book value. Only time value is all it has. The time value shrinks out 50 cents a week, 10 cents a day, Monday to Friday, $10 a contract per day. I come back to you and say, if you need to make $1,000 a week to live off of it, if you need to live on $1,000 a week, $4,000 a month, you need this contract or these contracts to bring you a return of $4,000 a month. If this contract brings you $50 a week, you need $1,000 a week. You need 20 of these contracts. You need to write 20, which means you need to buy 20 deep in the money options. In other words, you have to buy 20 of these at $35 each or $3,500 each, which is $70,000, in order to sell 20 of these for about I'm guessing about $4 each, $8,000 coming in, and then you'll buy them back for $3,000 and keep 5 for yourself. And that's 5 weeks, $1,000 a week to live off. Again, this is theoretical. I'm making a number of assumptions which all option traders have to make. You have to assume that the shares theoretically will stay under 135 a share in this 130 to 135 neighborhood. If the shares go below 130 or 135 to 128, 125, they want to go down there. The contracts you're writing, the $4 contracts, will go down in value even further than 150. They'll go down to 50 cents each. And you'll actually make a 350 return on a contract, but you'll have lost value on your stock. But one offsets the other to a great degree. You would buy these calls back for 50, 60 cents each and immediately write new contracts, which will be for September or October or November, and they will be then at that point 132s to 133s, 134s, slightly lower strike price because the stock is backed off. You'll bring in another $4 and rinse and repeat. On the other hand, if the shares go higher than 135, say they go to 140, AI is the big thing here. What if IBM goes to 140? It gets interesting because you brought in $4 in cash on a 135 contract. But that contract now at 135 with the stock at 140 is $5 in the money. It's worth at least $5 now in book value. If it has a little bit of time on it, it might be another dollar on top of that for time value with a month or so to go. It'll be trading at about $6. You only got $4 for it. You've lost $2 a contract on that right. You want the good news? I've got good news. You are long. You bought $100 call options. Those $100 call options that you paid $35 for, $3,500 each, at $140 a share, they're worth over $40 each. They're worth more than $4,000 each. In other words, they've gone up in value like the stock has gone up in value, because a deep in the money contract will follow the market higher. So if the shares want to go to 140 a share, that's an $8 gain right now. Your contracts could reach the $42, $43 level in relation, which puts you ahead by maybe $800 a contract. So you've gained 800 on your deep in the money calls, and you've lost 200 on the calls you wrote. You still had $600 per contract. You wrote how many of them? 20. You bought 20 deep in the money calls to write 20 calls. You're ahead $12,000. You need $5,000 a month to live on, so you can see where your account is growing faster than what you need to live on. What do you do though? People ask me, Bruce, look, if I'm writing calls against these calls and the market goes up on me, what's my next move? Your move is simple. If the shares want to run up into the 135, 136, 137 range, heading higher, you're going to buy your calls back in the $4, $5 neighborhood, and you're going to then write new calls that are going to be $140 calls for a month further out, September's, maybe October's. That will probably bring you $5.50 to $6 in premium, more cash in than you need to buy back the calls you've written, and you've just added or lifted your strike price to stay with the stock. You're going with the shares. Those deep in the money calls are going up in value no matter what. These short-term calls, you shifted them and you've done what we call a rollover. All of this information that I'm telling you about, there's a lot to absorb here, is available on my website, stockmarketswithbruce.ca. You notice this thing scrolling by all the time. You want to learn how to write call options, write poor man covered call options, how to do rollovers, how to calculate the difference between what it costs you to buy a call versus selling a call, what call to write and why, and how calls depreciate or appreciate. All of this is available on my website, and you can go to it anytime you like. 15 classes are available now. You can take them one at a time, whenever you want. And it's kind of like a plain English explanation on how stock options work. All right. So in this case, like I've said, with IBM, you could be a buyer of the stock for $13,200 per 100, or you could be a buyer of deep in the money calls for about $3,500 a call. And you can write options against either position. You can write one call against $13,200, or you can write 4 calls against $13,000 plus by buying 4 deep in the money calls, giving you more leverage, 4 times the leverage. And so instead of having to have something like $280,000 to be able to bring in enough money to live off of, you can theoretically live off of more like $70,000 in your portfolio. So if you have been saving away diligently and working away at your office, and you've got a 401k that is now sitting at 120 grand, and you need it to hit $1 million before you can retire, here's a way to bring income in from IBM by buying deep in the money calls and writing these calls against it. You're not going to spend this money because it's inside your 401k. You're going to keep your day job, but you're going to grow and compound your 401k by $1,000 a week at this point. Now, what you want ultimately to happen is IBM to go to $200 a share, to hit that all-time high level again and beyond. And AI could theoretically do that in the next year for IBM. But what will happen in your case is you will be actively managing your portfolio, because that's what you're going to do if you become an option writer. You're going to take over the management of your money. And you're going to write call options now, bring in this income, and you will roll over contracts if necessary if the stock slips higher. And you'll constantly buy back your calls and write new calls at higher strike prices as the shares go higher. Once the shares hit 150, just as an example, and you've written 152 calls against them, your deep in the money calls, which were $3,500 each, are probably worth now $5,500 each. Your IRA that had 20 of those, they're not worth $70,000 anymore. They're worth $110,000. Your account is that much more valuable, plus the option premium money you're bringing in the meantime. As every day goes by, contracts depreciate at about 10 cents a day, $10 a contract, $200 a day to you, $1,000 a week added to your account. So in 3 months from now, theoretically, you could have a scenario where you've generated 15,000 in returns, or something like that, 12,000 returns from option premiums. Perhaps your shares have gone higher. On top of that, your account is worth 135 instead of 70, just to give you an idea. A year from now, shares reach $200 a share. Hey, you've got deep in the money calls that have a $100 book value each. They started with a $35 book value, so they were worth $3,500 each. They're worth now over $10,000 each, and you've got 20 of them. That's over $200,000 in value in your deep in the money calls. So you're growing with the company. The shares go up, you get richer. Your option premiums keep coming in as you keep rolling them forward, and you'll bring in income there as well. And there is a brief idea of a poor man covered call strategy using, in this case, IBM. We're talking about Big Blue here. This company that, in the last month or so, the shares have done well. In the last year or so, they've been higher to the 150 level, as you can see right over here. But you don't mind. You really wouldn't mind if the shares stay between 125 and 135 if you're an option writer, because you're just going to bring in $1,000 a week in cash from depreciating options. On the other hand, if they want to go up $5 a month, every month they go up another $5 a share. To 5 months from now, they're $25 higher. You're talking a 162 stock. You wouldn't mind that. If they $5 a month for a year is a $60 gain, bringing you very close to $200 a share. AI has the potential of adding revenue to IBM's bottom line, huge profits. Every entity in the world needs to have the latest software for their systems. And AI is designed, ultimately, to make business more efficient, taking a lot of the mundane calculations out of businesses. And that means lower staff, less office space, larger server capacity, more software. High technology is going to enhance the profitability of all corporations and make government more efficient. That's the plan. That's the objective. Companies like IBM are in the front lines to benefit from it. They're not the creator of the intelligence. They're not the makers of the chips, but they're the ones that deliver this technology to the end customer, and the customer will pay dearly for it. Anyway, there's an idea for you, something to think about on a Sunday, June the 4th, 2023. I hope I haven't confused you too much. If you have any questions, let me know on my show. Come and join me Monday to Friday, 8:30 till 10:30 every day, Monday to Friday, on this channel, Stock Markets with Bruce. Head to my website right over there, stockmarketswithbruce.ca. You'll find my mug there on the front page. There's my front page of my website. Head over to classes right there, and you'll see your instructor. There's your instructor. Be nice. And here we go. Lessons 1 and 2, how to buy and sell call and put options, how to write call, put options, and call and put options, all different topics, all in plain English. Each of these classes run about 1.5 to 2 hours each, done with a live a gang of regulars of mine who are basically the same folks watching me every day. And they have become prolific option writers. Join the gang and learn number 11, using poor man covered calls, strategies to quit your day job. These are just some of the samples of the classes that are available. And you're welcome to join us anytime, Monday to Friday, live. Okay, I hope that helped. Thank you for joining me today, and we'll see you tomorrow live. Take care, everybody.